coming in via the waiting room, so we'll get those folks in as well. And we will get going for this morning's content. Got a great hour session for you. Obviously, a topic that's top of mind for many folks right now, and that is this whole notion of M&A and what the market looks like as we rounded out last year and head into this year. So I don't want to spend a whole lot of time on introductions of myself or anybody like that. I just would like to thank everybody for being here. Thank our panelists who put in a lot of time on the front side of this to make sure that we had good content for everyone. And I want to just very quickly thank our sponsors of the TEI chapter of Chicago. And those are quickly CIBC, Fifth Third Bank, First American Bank, Insperity, Cutchins, Robbins, and Diamond, Seyfarth Shaw, and Vedder Price. So those are the folks that help support the Entrepreneurship Institute and put programs like this together. So we're thankful for them. I'd like to turn things over to this morning's facilitator, and that is Ross Van Beek with First American Bank. He will introduce himself and then allow our panelists to quickly introduce themselves. Then we will get into the content. There's going to be ample opportunities for Q&A. Probably with a group of this size, the most efficient way to do that is to drop those into chat. I will be watching those, and we'll get those answered as they come in. And then we've got some questions that we're going to lead in with as well, just to kind of get juices flowing. So again, thank you all for being here. Ross, go ahead.
All right. Thanks for joining everyone this morning. I'm Ross Van Beek, a Senior Vice President with First American Bank. First American is the largest privately held bank in Illinois, which gives you direct access to our senior-most decision makers and lenders. I focus on commercial lending. I've been here for 15 years and service privately held businesses in the middle markets. And one of our first panelists is Rob Eisenstadt. Do you want to introduce yourself and your company?
Good morning. I'm Rob Eisenstadt. I'm a partner with the CPA firm of KRD, Cutchins, Robbins, and Diamond. We work in the lower middle market, closely held businesses, and smaller private equity groups, and I oversee the due diligence practice dealing with M&A for KRD.
Great. Thanks, Rob. From Rob, let's move on to Bob. Bob Sell.
Good morning, everybody. My name is Bob Sell. I'm a partner at Seyfarth Shaw. Seyfarth Shaw is an international law firm with almost 1,000 legal professionals now. I am in our corporate practice, and a significant part of my practice is working on middle market M&A transactions. I've been at the firm for over 25 years and looking forward to providing some insights on the state of the market today and some of the changes that have developed over the last couple of years as we've been dealing with a worldwide pandemic.
Great, thank you. Let's go on to Tom Goldblatt.
Hi, thank you, and thanks for putting this together. And it's nice to see so many people. Actually, it's nice to see anybody. It'd be nice to see people live again, but this will have to do. Tom Goldblatt, I'm managing partner of Ravinia Capital. We are a investment bank. We're focused on selling companies. We work with private companies, try to get the owners the most they can in a sales process and represent them. We work with healthy companies, and we also will help companies in distressed situations figure out the best thing or get capital. But our primary thing is sales of companies and advocating for business owners.
Great. And then our fourth panelist, Corey, I'm not sure, Bob, if he is joined yet. But
there he is.
All right, great.
I'm right here. Hello, everyone. Good morning. My name is Corey Sandrock. I am the founder and managing director of Pareto & Company. We are a lower middle market private equity sponsor based here in Chicago. We primarily focus our investment efforts and our growth efforts on businesses where we can partner with great smart operators and add our expertise to theirs and help grow their businesses. Again, in extreme lower middle market type industries that are highly fragmented and have a lot of owner operators where we can get to know the owners and help them think about strategies for their business. So we have 6 platform companies today, and excited to be participating this morning.
Great. All right. Thank you all the panelists and participants for joining us today. One of the topics that I'm sure on everyone's mind is, how has COVID impacted the current environment? So I was wondering if, Tom, you could start off by telling us what has happened with maybe some unusual financial results through the pandemic and how you view that.
Yeah, well, in M&A, it's been unusual. Certainly the pandemic didn't play out, but it's been a robust market, as a lot of people know. A lot of deals last year, maybe a record amount of deals, and mostly trading at higher valuations and higher multiples. But I think that is more so also in the larger companies publicly held. Most deals are kind of private equity to private equity. And we'll get into kind of what's making these values high. And also, I think that a caution on that is that sometimes these values, and it gets talked about a lot at the country club, these high values, and they are in the teens now. And I remember the day where people would say a 7, and we're talking about multiple of EBITDA, which is really kind of an easy way to get at, what's the future cash flow. But you do need to be careful because size does matter in M&A and what the growth is. And I think coming out of COVID, there's a lot of unusual results. Some companies did a lot better. Some companies did a lot worse. So we're having to kind of work hard to kind of get the buyer and seller to meet, and we're looking at things of averaging EBITDA over years or proving out our forecasts, looking at ways to compromise and have earnouts and other ways. It's complicated. I also found, which I haven't seen talked about a lot of times with the not private equity, but the strategic buyers, I found in the last quarter, they were pretty busy dealing with supply shortages and inflation and didn't have time, a lot of time for M&A. So we have a lot more to talk about. It's going to be interesting, but it's certainly unusual times right now.
And Rob, just being as active as you are on the valuation side, how do you see that flow through to your actual valuation process when you're taking a look at these companies?
Yeah, consistent with what Tom indicated, we're seeing a lot of unusual activity from a due diligence standpoint because we have companies that have reacted both ways. And some of them have taken a hit during the COVID times, and some of them really had their numbers inflated. So we typically are looking at historical numbers to figure out EBITDA averages or working capital. And a lot of times we have to make sure we're looking at adjustments because that stream that took place during this last 2+ years may not be indicative of really what the business is doing. So sometimes we have to adjust it down, sometimes we have to adjust it up, and take a look also even on the expense side if there's unusual numbers because companies were reacting in regards to government money through PPP, and make sure that any forgiveness income is properly excluded from those calculations as well.
Great. And gonna throw it on to Bob Sell now. From a legal perspective, is there any way that you can overcome these negative results? We've seen both positive or negative swings through the pandemic, but what have you seen within your client base?
Sure. Well, I would first of all just say, and I'm sure everybody has experienced this in one way or another, it's been the best of times and the worst of times. Certainly a lot of business activity, as Tom had suggested, and a lot of deals getting done. But at the same time, you have the businesses that are struggling and have had to take government support money, which creates an interesting due diligence question a lot of times. Certainly valuations have been good. But at the same time, there are a lot of deals that are still waiting in the wings from businesses that did not do particularly well. But at the same time, we have a lot of clients that are very interested in selling. So then as we move into 2022, I think the thing that we have noted, in addition to having a lot of business owners that are looking to sell. This has been a tiring period, right? People are getting worn out. They may have a desire to sell 2 years ago, and they've been waiting it out to try to get to the end of the tunnel. But on the flip side of that, Tom mentioned that strategic buyers have been sitting it out. We are having a lot of conversations with strategic buyers right now who are beginning to see that light at the end of the tunnel for themselves. And they're looking ahead and beginning to say, how do we begin to grow again? And can we buy some things that will be add-ons to our existing revenue that as we come out of this, maybe it's 6 months, maybe it's 12 months, maybe it's 18, but let's start to invest. And I think that dynamic is going to continue to fuel the marketplace and certainly help a lot of business owners that may not have the profile picture to be sold in ordinary times.
Yeah, and I know that personally within my portfolio, I had 2 customers that were purchased by strategic buyers within the past couple of months here. So maybe it is picking up a little bit more. Corey, and I know we were talking before this that, coming out of the pandemic, that perhaps there were some tools that companies can use virtually as they're moving forward and emerging out of the pandemic. So getting a little bit away from the due diligence and valuation, we'll circle back to that. But are there any tips that you have?
Yeah, it's a good question. And I think, in many ways they're related, right? I mean, I think based on what everyone was just saying on their last points, I think even amid all of the upheaval and the different crazy valuations and things that have been going on over the last 2 years, I think at the end of the day, you're still trying to find a way for a seller and a buyer to come together and agree on a price and agree on a process and make it easy for both sides to get what they're looking for, right? Incentives still matter. When I teach my economics students, I focus on that a lot because, as much as we may want to say it doesn't matter, it really does, right? We have to find a way to make it easy for everybody to get what they want. And if you are that seller who has been thinking about selling for 2 years or whatever, and you've been dealing with PPP or dealing with challenges in your supply chain or labor or whatever it might be that might be impacting your business, at the end of the day, you still want to find a buyer who's going to look at your business, think it's worth something, and then help you through the process. A lot of what we end up doing because of the types of businesses that we interact with, very small businesses, extreme lower middle market type businesses, a lot of times we're a new idea to them, right? Selling to a private equity firm might be something that they haven't contemplated before. And so a lot of our role is to provide education, not just, hey, here's my number, do you want to sell? It's here's what the process is going to be like. And it's probably going to take a lot longer than you think. You might be used to doing a deal on a napkin with your friend, and that's great. And that's a wonderful way to do business when it's possible. But, we have different LPs and partners and folks that, we need to provide a little bit more clarity to. And so for us, the virtual tools have made it so that we can get through a lot of those steps faster and more efficiently. And it's better for the seller too, right? If we don't need to come and sit in their office for 3 days to dig through a box of files, that probably frees up time for them to go make more sales, right? Or go meet with customers or go do the things that they need to do in their business. And so, throughout this pandemic period, first, honestly, because everybody was trying to figure out how to do it, we also jumped on Zoom and Teams and everything else. But also as the time has gone on, we've tried to leverage those tools for all of that front end work. If we're going to meet a potential add-on acquisition seller and we're going to do some initial diligence, we're going to try to leverage Zoom and Teams and scanning documents and those things in the front end phase so that we can learn things as fast as possible and be able to get questions back to them as fast as possible to be able to determine, are we still in this to work towards a transaction? And if everybody, keep marching toward that same goal, if we're all on the same bus, well, then, yes, eventually we do want to meet and have, a face-to-face, safely face-to-face conversation. But, we do want to meet at some point and understand, can we work together as people? But we've sort of flipped the script, and now we're doing that more towards the end of the process than I think in the good old days, right? It was everybody has to get on a plane to go as the first meeting, right? You have to spend a day going to the location to meet with that person and flying back, and potentially the answer is we're not going to move forward. For us now, it's like by the time we're having that meeting, it's all of the very key people in that room, us as buyer, them as seller, any key third parties, somebody like a Rob, Ryder, whoever might be, or Bob, any of the folks that would needing to be in that room are there. And then that's a very productive conversation because we've already gotten through all the sort of initial stuff. And now we're there to have a big, important conversation and make some decisions and move on to the next exciting step.
Good point, Corey. It sounds like a lot of your deals, you don't unfortunately have an investment banker on the other side, because we see our job is to educate them on what the process could, and also make sure you're not going through loose financials, everything's organized. But picking up on what you were saying about the changes since COVID, it's been interesting, and I agree with you. We're seeing a lot more of the initial management meeting post IOI, indication of interest, being by Zoom. And then when you get later visits, and even during the last year, we had a couple of sales with international buyers, and they never visited the company. So it's definitely unusual times.
So what has this done for expectation for a timeline for closing? I know that it varies a lot based on complexity and deal size, but if you're selling a middle market, lower middle market business, what's something realistic for a deal that's not happening on a napkin with a friend?
It's a good question, and I'll just jump in here quick with a couple observations. I think the timeline is always longer than a seller would like it to be. A lot of times our conversations with these owners is it's usually not you that's making it take longer. So look at us again as your partner. We're trying to help you use these tools. I didn't mention before, we use a lot of virtual data rooms as well to try to make it easy for a seller to just upload documents. We tell them, don't worry about where you're going to put those documents, just get them into the folder here. We can help you get them to the right parties, to the lawyers, to the accountants, to whoever needs them. But we try to remind that seller that we understand you're also running your business. You can't spend 24 hours a day getting us documentation. So do your best and get us everything you can. We'll come back to you. But there's going to be periods during diligence where you are going to have to go ask somebody else for information, right? You might need to call your insurance broker and get a loss run, or you might need to call somebody that has the title on your car because you can't find the original copy that you're selling to us or whatever. And that's where it can take a long time. That's the part that we say to the seller, look, if your insurance broker is on vacation for 3 weeks, there's not a whole lot we can do, right? Like, you got to get that person to get us that information. And so, we're seeing a lot of the deals that we do take, anywhere from, 60, 70, 80, 90 days to even beyond, not because seller and buyer aren't motivated, but just because we're trying to make sure we all do everything we need to do. And in the current environment, we can't drive over to their office necessarily and wait, right? And say give it to us now. It's we got to wait for somebody to scan it and send it to us, whatever. So I think everybody's still trying to get work done and move the ball forward. It's just taking a little longer than maybe it did in different periods.
Let me just interject with one thought if I can, and it's this. In any period of uncertainty, for those of us that have been at this for a really long time, any period of uncertainty sort of extends your timeline. And that, can be because of some of the complexities that are created by the current environment we've all been living with, but also the notion that a buyer doesn't know if another shoe is going to drop. And so a lot of times from a buyer's perspective, there's a desire to go slow, make sure that things are double checked in a period of uncertainty. That can be a little bit frustrating for a seller who wants to get out quickly. So I think just in general, I would say things have been moving a little bit more at a modest pace as opposed to a quick pace that you sometimes see when people think this is the perfect time to buy and there's a massive rush. Valuations are good, but there is a lot of deliberateness.
I would agree with those comments, looking both at clients from both the buy side and the sell side, particularly for first-time buyers that don't have a really good sense of all the boxes they have to check. There's uncertainties about what the banking process will be, and sometimes requests from a documentation or a legal standpoint pop up that just were unexpected. I've seen a lot of issues in leases where buyers taking over a business and has to negotiate new leases with the seller's landlords, and those don't always work out in the way that they want to. Corey mentioned insurance. There are a lot of those things that it's helpful to have a checklist going into that situation to know the things and the people that you have to line up in order to make a deal happen properly.
Well, it's like any project. It's like a Pareto. Things are going to go as long as they can without deadlines or some impetus to get it done. We see deals get expanded. The two biggest reasons we see them get expanded is that the diligence hasn't been completed. So they're like Rob said, they're searching for documents and stuff that could have been done months ahead, releasing UCCs. And then the lawyers also, the contract and the schedules. And again, these things can kind of be done up front, but we find kind of creating deadlines is really helpful because time is not on the side, because the longer you go, the more likely some event's going to come up to break the deal. It's one thing we like about distressed deals, actually, is those get done generally on time because there's a real impetus. Those can be done in 75 days. But we see, an average of a deal, you go in and if everything goes right, should be about 4 months, but it often takes 9 months, or even longer if the parties aren't motivated to get it done.
Great. Thanks everyone on the panel for that feedback. I do see that we have some questions coming through the chat. So we have one from Bill, which asks, what business sectors are you seeing the most activity in? Manufacturing, tech, healthcare? I'll let any of the panelists jump in if they've seen more activity in one space than some others recently.
I can just jump in with one observation. We have a platform company in the HVAC space. So that space continues to be insanely active. We are often going into conversations with a potential seller who has spoken to 10 or 15 versions of us, right? Or 10 or 15 versions of Tom on the investment banking side or the business broker side. So that industry remains very, very hot. For all the reasons that made it hot in the first place. Everybody's at home. If their air conditioner or heating system breaks, they're going to get it fixed. So that's one area that we're seeing continue to be strong, even now going into 22.
I think it's been fairly broad-based, but similar to what everyone might imagine. There are certain sectors that, because of where the economy is at, where consumers are spending their money, where there's been difficulty as a result of COVID, certain markets are lower than others, and that's reflected in some of the valuation reports. Technology for a while, which is one of the primary sectors that I focus on these days, was very, very hot. I think as you look at what the market does generally, for example, taking note of the fact that NASDAQ is down, buyers ultimately are thinking about what their ultimate exit is and taking note of what is happening in the market. There's a lot of movement to value, and speculative buys are becoming disfavored. And as a result, we're seeing a bit of a cool off personally at our firm with respect to the technology sector in terms of sales.
Okay, if no one else has a comment on industry, I'm going to stick with you, Bob. I had a question coming in that as you were talking about strategic buyers looking ahead, starting to invest, given the levels of EBITDA multiples, how are the strategic companies pitching deals to potential sellers and structuring them? Are you seeing anything different in the marketplace these days?
Yeah, I think it's interesting when we talk about the middle market, and I will, without naming any names, give a few examples. You have the classic business that's been around for a long period of time. It may be family owned. You may be moving into generation number 3 or generation number 4 if it's been around a long time. And believe me, as a counselor, much of what you're talking to those business owners about is their personal desire to see the business continue, even though they may be turning it over to strangers in effect. And so a strategic buyer, as they're coming to the table, if they can emphasize things like what is going to happen with the employees, what's going to happen to the business, what's the personal touch that a strategic buyer will give to the business on a post-closing period, what's their objective for growth. Those things can be advantages that sometimes overcome any money difference. A lot of times I think we always go into it believing that strategic buyers will pay more. There's been so much private equity money out there that the private equity folks have driven up valuations, frankly. They're falling all over one another to put their money to work, and there's massive amounts of money that has been available to them for that purpose. So strategics, I think the sale process that I typically see and where they turn out to be the winner is they're certainly in the hunt. Sometimes they overpay, and in past markets right now, I wouldn't say they're overpaying. They've been a little bit cooler than the private equity buyers. But it'll be interesting to see if they make a roaring comeback in 2022 and start to take some flyers again to get access to increased revenue.
It's certainly been a seller's market, and that's been true for a very long time. And I think people are always thinking it's around the corner that that's going to end. There was a lot of impetus to sell last year. There was thought that obviously that the taxes were going to go up. That's still kind of in limbo. But the interest rates have been so low that it's really made it's kind of made valuations go up. Now, we all know that interest rates are going to go up this year. So far, the market doesn't seem to be overly reacting. There's not been a correction, but typically higher interest rates will bring down valuations. If valuations meaningfully come down for the first time, there was a little bit that came down in 2018 and maybe for a blink at the beginning of the pandemic, but just keep going up, up, up. And the leverage also keeps going up. But if that changes, there'd be a whole new dynamic that we haven't really seen since 2009. But for right now, it still looks all good. And I would think if you're a business owner and you're thinking of selling at any point, now's the time to kind of get it going, because things can shift and shift fast.
Yeah, that's a good point on interest rates and the tax rate uncertainty. I know, Rob, we've been talking a little about how that uncertainty has been affecting your customers. Do you have anything to add?
Yeah, I think there was a tremendous amount of anxiety last year in anticipation that the early administration proposals and Congress proposals were for huge increases in capital gains. And that has sort of petered out at this point. The House package that went to the Senate did not include any significant changes in capital gains, even though that was expected. We still don't know whether the Senate will pass anything further along those lines, but it looks like the basic structure of capital gains is going to remain. It's possible that if a tax package does get passed, there may be some increases at the top end in ordinary rates. There were also concerns about changes in small business stock benefits to Section 1202. At one point, there was concern that might go away completely. There were some adjustments in the House proposal on 1202 that are going to reduce the benefits of it, but the basic piece is still there, which is good for startup businesses and companies that are investing in those small ones. One other one that I would mention that affects particularly say manufacturers that have heavy equipment, if they're selling and a big chunk of their gain might be ordinary because of depreciation recapture as opposed to capital gain. There was concern for pass-through entities that the benefit from the qualified business income deduction was going to disappear. That also got taken out in the final proposal. So that benefit is still there for pass-through for closely held business owners that are selling, that will still have that tax benefit for any ordinary income recognition that comes along the way.
Let me just add one thing to what Rob said for the benefit of any of our business owners that are on this call. I think a lot of times when someone gets ready to sell, like preparing a house for sale, we paint the walls, right? We make it look pretty. In the lead up period, do talk to your friendly neighborhood CPA like Rob, because, you know, in the planning phase, there are various things that can be done, and the timing, you know, your estate planning, things that you do from a foundational perspective to prepare for sale can make the sale more financially beneficial to you if it's done correctly and structured correctly.
You're talking to a banker's heart, having all those professionals lined up.
Exactly. Let's not turn over money that we don't have to, simply because things weren't structured in a thoughtful way in advance.
I both from a buy and sell standpoint, you know, I was taught early on that people in the country clubs who learn what they sold their somebody else sold their business for might be a number that's not an after-tax number. And then when my clients are looking for those projections, all of a sudden they get big surprises because of the tax cost. But I will add on the sell side, and I know Corey and I have worked in some situations where the tax structures had to be changed because the seller wasn't in a position to understand what the proper tax aspects might be. And sometimes it means that there has to be some change in structure from what was in the LOI in order to make sure that the parties are on the same page as to what the tax cost will be in the deal.
Okay, we have another question coming through, and we love that. We encourage anyone else has questions, please put those into the chat and we'll try and get to them. But how much activity is the group seeing from special purpose acquisition companies? Back.
Just jump in real quick. You know, I think it's one of those areas where everybody talks about it, but nobody has a friend that did one, right? Like it's the hot topic. And, you know, I certainly know people who have either launched them or sold to a SPAC. So obviously there is activity happening out there, but I think it tends to, our personal experience has been, it tends to be in the headline type industries where everyone's throwing money at the wall, as opposed to some of the more maybe off the run type industries where you have to get to know individual owners and get to know them. And, you know, they're not being courted by SPACs because they're, you know, probably sort of frankly too small for the interest of a giant SPAC. You know, they have a lot of money that they have to put out the door very quickly. And so I think it drives them into particular sectors.
I've got kind of a negative bias against SPACs just because I've seen them come into where we're selling a company and they'll try to entice the seller to, you know, that they're the best option, and they're really, oh, you can be a public company, and they're really not putting fresh money in. So it's like they're selling the company to themselves, but you get to be public, and then there's really nothing there. You know, I'm also just skeptical. You know, really it's IPOs without the same regulation and stuff. So you know, you don't know what you're getting. So it's kind of seems like a scam in a lot of ways, but there's a lot of things in the markets these days, a lot of things going on that, you know, kind of make us seem like we're kind of in bubbly times right now. And you know, I'm of the school, and I think a lot of people I see on this call are also, that, you know, things kind of come back to the fundamentals eventually. And if something doesn't make sense, it doesn't make sense, but you can't predict the timing of things. But I think SPACs I throw in that category is somewhat of a gimmick. And I think a lot of people are going to end up getting hurt.
I would maybe take a little bit different perspective on that. I can remember our first SPAC deals being, quite a while ago now. So SPACs have been out there. I think it's like anything, an acquisition vehicle that someone creatively comes up with has the right match, right? The right deal, it makes sense. A great number of deals, it makes no sense. I think we've seen a lot of SPAC activity in deals that have an international flavor to them. They're trying to gain access to the US equity markets. They can't do that. A SPAC is a good vehicle for that. So there are some circumstances where it's a good fit. It's logical. There's an ability to get market liquidity and maybe do it in a way that in an up period in the marketplace realizes value fairly quickly that's above and beyond the value of the business in a non-public market. So, again, I think some things and the comments that were made a minute ago are well taken. Some things get to have a certain cachet to it, and then everybody uses it. They sort of tag on to it. That doesn't make sense, right? But in the right place and time, it can be a useful vehicle.
I'm just trying to keep everybody awake at this hour.
Yeah, that's fine.
Great. All right. I don't see any other questions coming through. We've talked a lot about, COVID and the current marketplace and maybe some of the challenges as far as tax laws and things of that nature. Corey, do you see any other challenges right now as we're looking ahead in maybe overheated sectors and just M&A in general?
Yeah, I think it's an interesting time, partially maybe driven by SPACs, piggybacking on our last question, but also partially driven by the fact that, as we've all mentioned a little bit earlier, there is a lot of money seeking deals, whether that's from strategic buyers who have kind of had a pause for the last 2 years because of dealing with their own businesses, or from, private equity funds or other kinds of funds that have accrued some money during this phase that are sitting on some, quote unquote, dry powder and are looking to find the deals. And so, I think what's interesting is that, back to Tom's point, you still need to have a good deal. You still need to have a business that works, that makes money, that, has customers that are willing to pay for their product or service. And, you can't get away from that just because everybody's chasing something. And so, what we're finding, I mentioned we have a platform business in the HVAC space. We're finding that there are still great operators out there that we can partner with to acquire as add-on acquisitions. We've done several since forming our platform company, but it's taking a lot more of digging around to find those good locations and those good operators who are willing to sell at the fair, quote unquote, price. And fair, of course, can mean lots of different things, but to us, we want to pay a reasonable price for a good business. We're not trying to be the lowest bid, right? We're not trying to get away with something and pay less than we should for a company, but we also don't want to pay a high number just because the other side heard, back to Rob's point, from their friend that they got a big number, and so they think they should be worth that number too. And so I think the challenge when working in an environment that might be slightly overheated or slightly more aggressive in terms of valuations is you do need to walk a careful line of making sure that the seller understands that, like, we're trying to put together a deal that works for everybody. It can't only work for you, the seller, right? We, the buyer, have to be able to create additional value going forward. But that doesn't mean that we're trying to get away with something and pay you less than you're worth. It just means that, we can't just pick a number out of the air because you heard it on CNBC and you think you might also be worth that, right? We have to kind of go through some conversations and get to a number that makes it okay for everybody. And unfortunately, that means, right, that there are some opportunities that we will lose out on because there are others who are just throwing money and they're like, oh, you said 13 times, great. The last deal I looked at was 14, so 13 is better. Here you go. Let's more power to that seller, right? If you can get that number, good for you, right? Like I applaud the ability to get a good price for your business, but we sometimes won't be that winning bid because we're trying to find the right middle ground.
All deals end up, you can say the industry's a 12 multiple, an 8 multiple, it doesn't matter. All deals end up based off of the process, and it, really a dollar more than the second highest bid or the best alternative, just like negotiation. So, if, Corey or anybody is not going to pay any more than they really have to, and if it says I want 13 million, but they don't have another bid above 7, it's going to be very hard to get that, and eventually people will kind of find out no matter how much you bluff, but that's why it's so important to run a competitive process so that you have alternatives. And you really, like when we pitched, a lot of investment banks will go in, here's what the value is going to be. And they have, show, regression analysis and the risk, or they show discounted cash flow or alternative things. But, we show kind of a chart with a graph because it really depends on a lot of factors particular to that company. They could have concentration issues. They could, and right now, like the market today might be different than it was 2 months ago. And it depends. And if you can find that buyer, though, that has extra value to the company, not because of really the past results, but really it's based off of the future results. The negotiation happens about the past. And that's why Rob's work and diligence is so important, because you don't want to find things or you'll get traded down. But really the value is on what is it worth and what's the risk reward of that. And that's where it comes out. But to realize that value, the only way to do it is to run a competitive process.
Yeah, if I could weigh in on one other thing there. I totally agree with the concept that what we're trying to do is get a good price, but we also want to keep the money. And one of the things that's been a real trend, and I want to give a few statistics here because I think it's always interesting to understand what is market, is on the flip side, we enter into an agreement at the end of the day, which says, here are the things that I represent and warrant to you, dear buyer. And to the extent that something turns out to be wrong, there's a claim. And for lawyers, those are the kinds of things we're trying to avoid, right? One of the biggest trends has been the development of representation and warranty insurance in the marketplace. And it's really altered the way that buyers and sellers interact when it comes to the risk associated with a deal. So the basic fundamentals of that, from my perspective as a lawyer, we have an outside insurance company. They are issuing an insurance policy. They're reviewing the agreement. They're reviewing the due diligence. They're reviewing schedules. They're asking questions of the seller. And at the end of the day, what that does is it knocks down the risk, right? There's an insurance company standing behind what's happening. And I think it also affects the dynamic of the money. So what I wanted to point out, just a couple of statistics here. On escrows, we used to be really aware that a buyer might ask us to hold some money back or have some money put in an escrow that they could claim against if a rep and warranty was untrue. Uninsured deals, the amount of the escrow has dropped dramatically to the point where our data shows 91% of insured deals have an escrow that's less than 1% of the purchase price in the middle market. On an uninsured deal, you may be talking about an escrow that's 10%, okay? So think about that from a real dollar perspective in terms of what you have as a continuing risk post-closing. And then the other thing that we're noting over the last few years is that the survival period on claims is also greatly reduced when you're talking about an insured deal. So what I mean by that is, can I claim against you as the seller as opposed to looking to the insurance policy? And that number of deals where we're just seeing people look only to the insurance policy has increased greatly to the point where now it's 40% of the deals, okay? So if there are any follow-up questions related to things like that, we do have a regular survey that we do, which you can find on Seifarth.com, related to where deal terms are these days, and it might be of interest to you. Thanks.
Well, this is a great discussion, but I think the coffee kicked in. We've got a lot of questions that are coming through here. So any advice about how to integrate an acquired company during a pandemic? I'm thinking, Rob, you might have some insight into that, or Corey using the virtual platforms, if either of you has any comments.
Yeah, I mean, I would say we just actually at our firm, we just had a smaller firm that merged in with us. And now you have this challenge that you have people that have to work together, and everybody's been used to working virtually. And you know, to the extent that you can find an opportunity during COVID to have people meet in person, it's certainly always better than the virtual meet and greets. But you have to at least do that because people need to see a face that they're going to be interacting with, and not just through an email. And from a system standpoint, always, I think, whether it's a service company or a product-oriented company, to the extent that you have your processes in place to make things easier for the people that are joining your organization. You don't want a lot of uncertainty as to how they need to do things, because it just delays them doing what they need to do to continue to move the business forward. So from a planning standpoint, the more I think that you can put together those processes ahead of time, it will stand to be a much higher degree of success in integrating people in this environment.
I think that's right. And the one follow-up I'll add on to that in terms of, how do you integrate within a pandemic? I think a lot of the answer is the same as it was before the pandemic, which is you have to get to know the people that are joining the team. To Rob's point, if you're the larger entity that's coming in and buying the smaller entity, or, in a lot of times our case, we might be acquiring a couple of smaller companies to create the platform and doing it concurrently, right? And so you're sort of slamming together different cultures and ways of working. And I think a lot of what we did before the pandemic is what we're doing now, which is like getting people to talk to each other and figure out, like, how do you do something, George or Jenny, and how do you do, Steve or Sandra? Let's talk together and figure it out. And now the virtual piece becomes just a tool to facilitate that conversation. It's not an excuse to have a pointless meeting, right? It's, we don't need to have 3 Zooms a week, maybe with every single person, just because Zoom is cool and fun. We need to use it sparingly to have those meaningful conversations, just as we would have when we were doing it live. And so I think that part, sometimes people get distracted by the technology and want to, use it all the time constantly because it's something different than we did before. But at the end of the day, we still have to motivate people. So, I think it's an important question, but I think a lot of it's the same answer as it was before.
Great. Okay. What financing and leverage are you seeing in lower middle market deals?
Well, I would say that the leverage is, first of all, very different in the lower middle market than the middle market or upper middle market, where they have, let's just say higher than 10 million EBITDA. Those things are easily financed and, very competitive and probably at record amounts. In the lower middle market, though, it's hard to get kind of multiples of cash flow. I think ABL becomes more popular, but I would kind of throw that out because it changes. There's a lot of bankers I see, like Steve Olson, Arnie Brown, people like that, that might have a better answer to this. Ann O'Connor, others.
Oh, Ross, you may have thoughts.
Yeah, I mean, this is a little bit outside of my area of expertise. I know we have Ahmet Markisic from First American on the line, who is more active on this on a day-to-day basis. But yeah, I don't have much to add to that.
Okay.
Tom, I would agree with you on the this Arnie Brown on the larger deals. You know, $15, $20 million EBITDA multiple deals. I think they're a lot easier to finance. When it gets to the smaller middle market, you've got more challenges. You're looking at a little bit more complexities with regard to financing. You know, we're very open-minded at Fifth Third Bank at looking at those deals, but you know, there's a little bit more that goes into it, a little bit more challenging. I agree with you.
I think one of the last things, just very briefly, you know, a lot of our smaller family-owned businesses are SBA financed. The fact that they're SBA financed helps to sort of validate the fact that the business is bankable. And then if the buyer has the ability to, in effect, swap themselves out, if they're, you know, an individual buyer, for example, in a smaller middle market company, lower middle market company, you know, seeing that there's already SBA financing in place can be a part of the due diligence process.
Yeah, SBA is a great tool for lenders to expand amortization and do deals that otherwise couldn't be done. Whenever you're dealing with the government, though, you have a very specific toolbox that you're working with as far as what deals qualify.
No question. Your hands might be tied, but the notion that the business may have got through that gauntlet, if you will, is helpful.
The other piece that I would add to that for the smaller, particular first-time buyers, SBA, I see quite frequently in those situations, the buyer may have set aside a certain amount of money that's going to be from an equity standpoint that the SBA mandates in those situations, but that might not be the last dollar that they need to put in. I think they really need to assess a contingency fund because you have additional costs coming through after closing that you might need to do from a further investment standpoint, either from a transition dollar perspective. There may be other things where, oh, you know what, we need to front additional dollars out there. So particularly for the first-time buyers, I think it's really important that they don't run short on the amount of assets that they've put aside in order to get the business up and running and generating the natural cash flow that it's supposed to do.
Yeah, Rob, one more thing I want to add on the SBA stuff. The one challenge you might have there too is depending on the size of the deal, from a leverage standpoint, the SBA has limitations as far as the amount of credit that could be extended. But we're an approved SBA lender on that too, but it's sometimes limited.
Great. So
unfortunately,
I did see, Ross, there was a question about, you know, what makes a good deal for a buyer, and maybe we can just dialogue about that. I also saw a question that's focused on, I think, where the M&A market is headed.
I think we only have time for one more question. So I think where the market is headed, and someone said, is there anything that really could put a pause or stop on what's a frothy market right now? So I think that's probably going to be our final question of the morning here, if I can get feedback from the panelists. And I thank everyone for their participation. I know that Zoom sometimes isn't as interactive, but that's not the case this morning. We've got a lot of great questions and appreciate everyone's time this morning and jumping on the line with us.
Now, I would say the M&A market, it certainly looks like it's going to keep roaring ahead. There's literally trillions of dollars, you know, in private equity. We've talked about strategics have lots of money on their balance sheets, high valuations. You know, so it certainly looks like banks are wanting to lend. All that is go, go, go. You know, I'm just going to caution. I say this a lot, but like, people act like they can predict when things are going to turn, and historically that never is the case. Whether you're talking about the tulip bulb bubble, or you're talking about 29, you're talking about 2008, it always kind of comes when people don't expect it. And then there's a real change in attitude that, whereas everybody kind of was optimistic and thinks it's, good money to take this risk, all of a sudden it gets caution and tightens up. So it can flip on a dime. I think what's happened the last couple times, though, there's been indications is that the Federal Reserve and the government has come in and bailed out things, and then it's smooth sailing. I do think there's things on the horizon that show that our government is not going to be as cooperative. I think inflation's the highest it's been in a long time. So I think there's a lot of signs that things could flip. And then those leveraged loans, where it used to be when maybe we got into it, that it was a 2 or 3 time leverage and a deal would go 5 or 6 times EBITDA. Now it's 5, 6, 7 leverage, and deals are in 10 to 12 for bigger kind of growth companies. So if it flips, then I think you're going to see a lot of, could be quite a change, but most likely it continues like this for a while.
I think Tom is right that there is a lot of noise out there that is going to make it hard to predict the shape of the M&A market, but I do think M&A will continue in some form because there is money looking for opportunities, right? And so I think it comes back to, can you find a good deal where a buyer and seller can agree on a reasonable price? And then a little bit on the question of what can the seller do for that buyer? Is there a good management team or individual or legacy employees that is sticking around to help continue to take it going forward, right? For us, we're always very hyper aware of the fact that we don't know everything, right, as a buyer, and we need folks to partner with to help us continue to grow that business. And so I think even if the world changes, to Tom's point, and maybe M&A slows broadly, there will still be opportunities to find smart operators that you can invest in, help grow their business, and maybe do some M&A or whatever after the fact. It might just be in smaller and less flashy ways, but there still are good businesses, I think, to be grown out there.
I think that's an interesting observation, Corey. We're going through this great resignation period right now, and there seems to be little impediment for people just to decide to leave their jobs, and what that's going to do in terms of key employees in target companies on a company by company basis still remains to be seen. But that's a real challenge right now, and I think that, if anything, could wind up having an impact again on a deal-to-deal basis.
I'll be really brief for us. So what I would simply say is first quarter is about what was happening at the end of the year that didn't get closed. There is a lot of carryover. And what's the reason? Because there wasn't the same pressure on taxes that everybody thought there might be. And so things that weren't ready to close got pushed. So there's going to be a lot of closings in the first quarter. The other thing I would say is we look forward based on the sentiment of all the different CEOs, business leaders we talk to, similar to Rob, we're counselors. So we talk to an awful lot of people across all our professionals. I think the sentiment is very good right now. And again, similar to my early remarks, everybody's looking forward to the end of the tunnel, and they're planning for that. And one of the ways they're planning is by looking for targets that will enhance their revenue.
Great. Well, I want to say thank you again to all of our panelists. I think it's been a great discussion. I'm going to throw it back to Bob at TEI. I understand that it's 9:05 here, but there were some questions we weren't able to get to, but luckily this isn't the only program we put on during the year. So there's plenty of opportunities for more discussion.
Yeah, that's great. And thanks, Ross. I'll add my thanks to him and Tom and Corey and Bob Sell and Rob Eisenstadt. I appreciate the time that you put in ahead of this and the commentary for this morning. I dropped in the chat, yes, we do have a hopefully in-person event coming up on May 12th. We'll do that at Rolling Green Country Club, and we'll get details to you as we get closer to that. Everybody is welcome to register for that program. This, of course, has been recorded, so it will be available here in probably the next day to two on our website, and I will send the direct link to everybody here that registered And if you have questions that didn't get answered, I can get you contact information for anybody on this panel that you would like to visit with. Just shoot me a note. And again, happy to have everybody here this morning. Everybody have a great rest of the week. Stay healthy, stay safe, and hope to see you in May. So thanks all, and have a great Wednesday.
Thanks.
Well,
Thank you.
Thank
Great
you.
job, Ross.
Thanks all.
Great job, guys.
Everyone.
thank you.
Take care.
Thank you, Rob.